Welcome back to Investing Talk podcast.
Great to be here.
Today, we're tackling a question that, well, I know has been on a lot of your minds. Is this a good time to consider buying stock in Idaho Strategic Resources?
Yeah, it's a really interesting one.
It really is. It's a fascinating puzzle, A company showing truly explosive growth.
Absolutely explosive.
Yet there are some signals there that might give investors a bit of pause.
That's the crux of it.
So we've pulled together all the latest analysis, the data, kind of sifted through everything to try and give you the most complete picture possible.
Yep.
And hey, if you find this analysis helpful, please remember to hit that subscribe button.
Definitely helps us out.
Give us a like, maybe leave a comment. Let us know if there's another company you'd like us to look into next time.
We love getting those suggestions.
And, if you're feeling generous, consider buying us a coffee to support the show. The link's below.
Much appreciated. So, Idaho Strategic Resources, or IDRs, as we'll probably call them, they operate in that critical and often pretty volatile space of gold, silver, and also rare earth elements mining, mostly out of northern Idaho.
And our mission today really is to help you navigate the complexities here.
Exactly. Especially for a company that's seen such rapid appreciation. I mean, the stock price has really moved.
It really has.
But it operates within a sector, mining, that just has inherent risks. So we want to empower you with the facts, what they might mean, so you can make your own informed decisions.
Okay, let's start unpacking this growth story then, because some of these top-line numbers are, frankly, pretty impressive.
They really jump off the page.
IDR reported trailing 12-month revenue of $30.50 million.
Solid number.
And here's the kicker, really. Their net income came in at $8.88 million.
Which is a huge leap from before.
We're not just talking growth, we're talking like dramatic expansion. Their 2024 revenue up 88.66% year over year.
Almost doubled.
And net income exploded over 663%.
Wow. Yeah, that's the kind of number that gets attention.
Absolutely. And analysts are looking ahead, too. They expect earnings per share, the EPS, to improve further to about $0.76 in 2025.
Which is another, 13.4% increase?
Exactly. And on top of that, we've seen recent upward earnings revisions, too, so that suggests the momentum is still there operationally.
So a lot of green on the ledger, as you said.
Yeah. But that's where it gets interesting, right? How does that compelling growth story connect to maybe the deeper financial reality?
Well, that's the critical question, isn't it? While those numbers are undeniably strong, it's so crucial for any investor to dig just a bit deeper. Because when we look at the costs involved, specifically their cash costs per ounce,
okay,
we see a pretty notable increase there. These went from about $904, maybe $905 in 2024,
right,
up to $1,064.68 in 2025.
Oh, that's a decent jump.
It's not insignificant, and it points towards potential margin pressure.
Right. So revenue's soaring, but the cost to get each bit of gold is also going up.
Exactly. So the profitability per unit might be getting squeezed if they can't get those costs contained.
That makes sense. It's a classic sign sometimes that maybe explosive revenue growth can mask underlying issues, right?
It can, yeah. You could end up with what some people call profitless prosperity if it's not managed carefully. It's a detail that's easy to overlook when you see those big headline growth numbers.
Oh, okay. That's a really critical distinction. So if costs are a potential pressure point, what about the rest of their financial health? Are they, stable enough to handle that?
Well, looking at the market cap, it's around $344.65 million.
Okay.
And with positive and, importantly, growing earnings, it certainly paints a picture of financial stability. It suggests they are generating significant income.
And how does that connect to their overall financial strategy, like debt, cash flow?
Yeah. So while the sources we looked at don't give us super granular debt and cash flow figures, the strong earnings, plus the fact they aren't paying out dividends, that suggests a very deliberate choice.
Reinvesting.
Exactly. It really implies the company is prioritizing reinvestment back into the business for growth, for expansion, rather than giving cash back to shareholders right now.
Which isn't necessarily bad, especially in mining.
Not at all. It shows a focus on fueling future growth. And crucially, our sources didn't note any major red flags like excessive leverage or liquidity problems. That's a positive sign for you to consider, especially in such a capital-intensive industry.
Right. You need that capital to grow, and that reinvestment must be crucial for them trying to expand.
Definitely.
Now, let's talk competitive position. You mentioned diversification earlier. gold, silver, rare earths.
That's a key strength.
And they reported record quarterly results, especially from their golden chest mine. That seems to underpin some strong execution in the market.
It does show good operational performance.
Yeah.
But just to add a bit of nuance there,
Okay.
while diversification is a strength, you have to remember IDR is still relatively small. I mean, market cap-wise, compared to the big global mining giants.
True. They're not a BHP or a Rio Tinto.
Not even close. And that size difference can imply a few things for you as an investor. Maybe less pricing power in the broader commodity markets,
Right.
and perhaps higher project-specific risks compared to the giants who have, much deeper pockets and more established operations globally.
That's an important distinction. A smaller player might have to work harder for every win, potentially.
Potentially, yes. It's something to factor in when you're looking long-term.
Okay, so we've got a picture of their operations, their finances. But the critical question for any investor is always, what is the market actually saying about this company's value right now?
Yeah, the valuation metrics. Let's get into those.
Okay, so their trailing 12-month P/E ratio, it stands at 37.13.
Which is quite high.
Yeah, and their forward P/E looking ahead is 27.95.
Still pretty elevated.
For context, their EPS, earnings per share for the trailing 12 months, is $0.64. And as we mentioned, no dividend yield here.
Right. And this is where it gets really interesting comparing those multiples, because they are relatively high, especially when you stack them up against the broader materials or mining sector.
Which usually trades lower, right?
Much lower forward PE ratios typically. So this higher valuation for IDR suggests a couple of things. Either the market is banking on such strong future earnings growth that the company will quickly, grow into this valuation, or it's placing a significant premium on their specific niche in critical resources, like those rare earth elements, which are obviously increasingly strategic.
So it's pricing in a lot of optimism, or maybe near perfection.
That's a good way to put it. A high PE isn't just optimism. It's the market demanding strong execution. Any stumble, and the fall could be just as dramatic as the rise was.
Okay, and speaking of what the market thinks, let's look at the analyst price targets. Because here we see a bit of a mixed signal.
Yeah, there's some disagreement.
One analyst sets a 12-month target way down at $17.50, which, given where the stock is trading now, suggests potential downside.
Right, quite a bit of downside.
But then another source we saw notes a price target increase up to $21.
Still below where it's trading currently, though.
True, but less pessimistic.
Yeah.
So how do we reconcile that disagreement for someone looking at this?
Well, the implications of those diverging targets are pretty crucial to understand, I think.
Okay.
It suggests that while the different valuation models are likely factoring in the company's strong near-term earnings momentum.
Right, that 663% jump.
Exactly. But some analysts might be exercising, let's say, significant caution about whether that kind of rapid growth is truly sustainable.
Makes sense. Can they keep it up?
Precisely. And that leads to these varying outlooks. It really highlights the uncertainty involved in projecting the future for a company that's grown so explosively in a fairly short time.
So the disagreement itself is maybe a data point for investors.
I think so, yeah. It shows not everyone's convinced the current price is justified long term.
Okay, let's shift gears a bit and look at the stock's actual movement. Technical analysis time.
All right. The charts.
The shares are currently trading near their 52-week highs. The recent range is like $23.19 up to $25.08. And just for perspective, the full 52-week range has been from a low of $9.58 all the way up to a high of $25.87.
So a huge run from the lows.
A huge run. But what really stands out is the recent rally. The stock is up a staggering 47% over just the past 4 weeks.
Wow, yeah. That's incredibly sharp.
So if someone's thinking about buying now, what does that kind of rapid run-up tell us, technically speaking?
Well, connecting that to the broader techno picture. While the trend is obviously strongly positive, right? You can't argue with 47% in a month.
No.
But that kind of rapid appreciation often suggests what technicians call overbought conditions. Meaning the stock has potentially risen too far too fast. It might be susceptible to a pullback or at least a period of consolidation sort of moving sideways for a bit.
Like catching its breath.
Exactly like catching its breath. It's like a sprinter who just ran a really fast 100 meters. They probably need a little rest.
Okay. What else do the technicals show?
Interestingly, its beta is 0.72.
Which means?
It indicates below market volatility overall. So historically, it tends to move less drastically than the broader market average.
Seems a bit counterintuitive given the recent run.
It does, but beta is usually calculated over a longer period. The recent move has been very sharp, but its longer-term profile might be less volatile. However, the key point technically right now is that the current price is substantially exceeding those consensus analyst targets we mentioned.
Right, the $17.50 and $21 targets.
Exactly. And that gap strongly implies potential for either a retracement, a pullback, or maybe even a more significant correction in the near term.
Definitely something for potential buyers to watch closely then.
Absolutely.
Well,
Entering after such a sharp run-up always carries that risk.
okay, so what's the word on the street? Beyond the charts and the financials, let's touch on recent news and market sentiment. Well, the company recently reported, as we know, record second quarter operating and financial performance, showcasing really robust year-over-year growth. That obviously helps explain some of that price action.
No doubt. Good news tends to drive prices up.
And the analyst consensus rating is actually a strong buy, which sounds great, but it comes with that big caveat we discussed. Their actual price targets are lagging behind where the stock is currently trading.
Yeah, it's a bit of a disconnect. We think you should buy it, but maybe not at this price.
Kind of feels like that. Zacks also gives it a #2 buy rating, reflecting those positive earnings estimate trends.
Right, and adding some insight into sentiment based on what we've seen.
Yeah.
It seems investor sentiment might have cooled off just slightly after this latest huge surge, even though those earnings estimates keep getting revised upwards.
So the markets may be digesting the move, taking a breather.
Possibly. It's subtle, but it could mean the market is questioning whether the current price truly reflects all the good news already, or maybe if it's overshot a bit.
Okay. What about insider activity? Any buying or selling?
Our sources didn't provide any recent specifics on insider trades.
All right. And retail sentiment?
Well, judging by the sharp move, it certainly seems bullish among retail investors.
But that carries risks too, right?
It does. That kind of near-term exuberance can fade pretty quickly if expectations moderate, or if, that rapid growth doesn't quite materialize in the next quarter. Often, after a run like this, the sort of easy money might have already been made.
Good point. Okay, looking ahead then, what's next for IDR? Any upcoming catalysts that could move the needle?
Well, we know about the recent earnings report from August 7th, which showed that strong growth.
Right.
Beyond that, ongoing drilling and exploration updates from their work in Idaho could definitely offer operational catalysts. Positive results there could boost sentiment.
Makes sense. Anything longer term?
Absolutely. For long-term drivers, you really have to consider the potential impact from broader commodity prices.
Gold, rare earths.
Exactly. These are cyclical markets, and IDR is directly exposed. A sustained rise in gold or rare earth prices would obviously be a tailwind.
And a fall would be a headwind.
Precisely. But maybe even more critical, especially for the long haul, is monitoring their progress on actually expanding and developing those rare earth element projects.
Why is that so critical?
Because success there could fundamentally shift their valuation. It could give them a much larger, more strategic footprint in a really important sector.
Okay. So that's a key thing for long-term investors to watch.
Definitely. And also, any broader macroeconomic shifts or, importantly, regulatory changes affecting strategic minerals globally could significantly impact IDR's position and value over time. These are those larger external forces you can't ignore.
Right. Lots to keep track of. Now let's talk risk. Every investment has it. IDR is no exception.
Very true.
Let's tackle stock-specific risks first. Our sources mention high operational leverage, and also that it's relatively small scale compared to peers. Can you maybe unpack operational leverage for us?
Sure. Think of operational leverage like a business with high fixed costs, maybe a factory or even a movie theater.
Okay.
Once you've covered your big fixed costs, the rent, the machinery, the basic staff salaries, every extra dollar of revenue, like selling one more movie ticket, contributes much more significantly to profit.
Because the main costs are already covered.
Exactly. It amplifies profits on the way up, which is great when sales are booming.
But
the flip side is, if sales drop, those high fixed costs remain. And losses can accelerate just as fast on the way down. That's operational leverage. It magnifies both the good and the bad results.
got it. So it cuts both ways.
It really does. And combined with IDR's smaller scale, it means they might be more vulnerable to market shocks or operational hiccups than a larger, more diversified mining company.
And we already talked about those rising costs.
Right. That substantial cost inflation, those rising cash costs per ounce we mentioned earlier, that's a tangible risk right now. It could really compress margins, making it harder for those impressive revenue gains to actually flow down to the bottom line to profit.
So the growth could be masking some underlying risks there.
It could be, yes. And frankly, that heavy price appreciation we've seen recently.
The 47% jump.
Yeah. It might have pulled forward a lot of the expected future returns, meaning a lot of anticipated good news might already be baked into the current stock price.
Which increases the risk if things don't go perfectly.
Exactly. It increases the downside risk if future results disappoint even slightly, or if, say, gold prices soften from here.
Okay. Beyond the company itself, what about broader market and sector risks? We touched on commodity prices.
Yeah, primarily that volatility in gold and rare earth prices. That's huge for them.
How do investors even begin to account for factors the company can't control?
It's a classic challenge in this sector. Mining is inherently cyclical. Its fortunes rise and fall with the global economy.
It's heavily impacted by global risk sentiment. Think about geopolitical tensions, trade wars, things like that. And also macro factors like interest rates and inflation.
Which are always changing.
Constantly. And changes there can drastically affect demand and pricing for the commodities IDR mines. So for you, the investor, it means understanding that even if IDR executes perfectly internally,
Right.
these external forces can still swing its stock price wildly.
And there's permitting risk too, I imagine.
Oh, absolutely. For any resource development company, there's always regulatory and environmental permitting risk. Getting approvals for new projects or even just maintaining existing ones can be a long, unpredictable, and often costly process. It just adds another layer of uncertainty you have to factor in.
Okay. So after sifting through all this, the growth, the cost, the valuation, the risks, the overall rating we're seeing from our sources for IDR comes in at 6.5 out of 10.
Yeah. So not a screaming buy, but not a definite sell either. Kind of middle ground.
What's the thinking behind that sort of lukewarm assessment? Well, to summarize the rationale, Idaho's strategic resources clearly shows compelling revenue and earnings growth. That's undeniable. It has a robust operational expansion story going for it, and that recent strong momentum.
All right, the positives.
Right. However, the valuation is, let's be honest, stretched. Relative to its sector averages, relative to where analysts think it should be trading, the current price already seems to reflect very high expectations. And we've highlighted those significant cost pressures and the execution risks that loom pretty large. Can they manage those costs? Can they deliver on the rare earths?
Big questions.
Plus, from a technical standpoint, the charts suggest potential for near-term consolidation, maybe even a pullback after that huge rally.
So who is it maybe suited for then?
It seems well suited for investors specifically looking for high-growth, small-cap resource plays, people comfortable with that higher risk profile. But the risk-reward right now seems less favorable for new buyers at these current levels, just given how much the stock has already run up.
Okay, so thinking about investment horizon, if you're a short-term trader.
Yeah, for short-term trading, the stock seems very likely subject to near-term volatility. Profit-taking seems quite possible after those rapid gains.
So tight stops, maybe? Risk control is key.
Absolutely. Strict risk controls would be essential if you were trading it short term.
And what about for a long-term investment?
For the long term, IDR could be suitable if you have a really strong conviction in management's ability to deliver.
What specifically?
Deliver further cost improvements, first off.
Right.
And successfully execute on that resource expansion, especially getting those rare earth projects moving forward profitably.
Okay.
But you'd have to go into it expecting high volatility. And you'd need the potential tolerance to withstand significant drawdowns in your investment along the way.
So it's not a set it and forget it kind of stock.
Definitely not. It demands a watchful eye and really a strong belief in the long-term strategic value of the resources they hold.
Okay. So boiling it all down, what does this mean for your portfolio, for the listener? Idaho Strategic Resources presents undeniably an interesting growth story. But after such a major run-up, both the current valuation and those inherent execution risks really seem to warrant caution for new buyers right here at current levels.
Yeah, it's that classic balancing act, isn't it? Balancing that impressive growth against what you're actually being asked to pay for that growth today.
Exactly.
And I think, given the really high expectations currently baked into that share price, the real test for Idaho Strategic Resources now isn't just about achieving more growth. It's about demonstrating sustainable growth, profitable growth, especially in the face of those rising costs we keep mentioning.
Right.
So the question for you, the investor, isn't just can they grow, it's more like can they grow profitably enough to truly justify the premium the market is placing on them right now.
That's the key challenge ahead for them and the key question for potential investors.
That sums it up perfectly, I think.
Well, thank you for joining us for this look at Idaho strategic resources. We really hope this has equipped you with some useful insights to help you make more informed decisions.
Hope it was helpful.
And please remember to subscribe, like the video, leave a comment with your thoughts, or maybe suggest a company you'd like us to analyze next time.
We do read those comments.
We do. Thanks again for tuning in, and we'll see you next time for another insightful analysis.